Hello and welcome once again to Policy Watch, our weekly show that keeps you abreast of all the major macroeconomic developments of the week. Today, the three top stories that we have zeroed in for you for our show are first, the sharp rise in inflation numbers. The second, what Warren Buffett, the legendary investor, called weapon of mass destruction, the impasse on the US debt ceiling. And last of all, we take a look at the trio of Nobel Prize winners in economics. And to throw light on these stories and more today, we have with us Dr. Arvind Virmani, former Chief Economic Advisor to the Finance Ministry and Executive Director, IMF. Welcome to the show, Dr. Virmani. Well, after a brief lull, inflation is back on the front pages of all the dailies. When the wholesale price inflation crossed 6% in August, everyone hoped it was an aberration and September would bring better news. But far from WPI numbers cooling in September, the WPI has increased to 6.46%. For consumers, there was worse news in store. Not only did consumer price index 2 inch up to close to 10%, but food inflation continued at over 18% for the second consecutive month. Why has there been so little success in taming inflation? And more importantly, why is the government so seemingly nonchalant about it, even though the elections are not far away? We'll ask Dr. Virmani, but first this Bureau report.
Skyrocketing onion and vegetable prices and costlier staples such as rice pushed wholesale inflation to 6.46% in September from 6.10% in August. The rise has been driven by food prices, which grew at 18.40% in September compared to 18.18% in August. Wholesale onion prices grew by over 300% during September on the back of 244.62% in the previous month, while on countrywide basis, wholesale vegetable prices grew almost 90% in September, up from 77.81% in August. The government had hoped food prices will start falling on the back of a good monsoon this year, but Cyclone Palin, which left a trail of destruction along the eastern coast, could wreck a fertile rice-growing belt where the main summer crop is at a ripening stage. In fact, it has been estimated that the damage caused by Palin could shave off 1% of the country's total rice output. This could push up prices of rice even further. Retail inflation, which is measured in terms of the consumer price index, meanwhile rose to 9.84% in September. It was at 9.52% in August. Retail inflation for rural and urban areas in September stood at 9.71% and 9.93% respectively. The same was 8.93% and 10.32% in August. High inflation means the RBI, which will present its mid-quarter credit policy review later this month, could hesitate to cut interest rates, a step needed to boost economic growth. Ahead of the festival season, high borrowing costs will likely dampen purchases of cars and other consumer goods, which are mostly bought through loans. Bureau Report, Rajya Sabha TV.
Arvind, why is it that we've had so little success in taming inflation?
Well, some of us have been saying, myself in the finance ministry since 2008, 2007 actually, that the basic problem is structural. You know, you had an acceleration in the rate of growth of GDP by about 2% points from roughly around 2003 onwards. And so the pace of demand growth has accelerated sharply. On the other, that's one side, the demand side of the story. And on the other hand, the supply side has not changed. I mean, we have been talking about productivity in agriculture for decades and decades, and there is no real reform of the agricultural sector. So these two things given together mean that the supply chains are no longer able to keep up with the faster demand. That is the broad overall picture. Now, within this, there are specific problems, all related to the supply side. One is, of course, the stocking policy. You know, even in 2009, when I was CA and I was attending the relevant meetings, I had pointed out that we got more than enough stocks, way above technical. You know, 20 years ago, 30 years ago, I attended committee meetings where we used to set technical limits on stocks. We are way above that.
So is it because the government was kind of keeping it in mind, the Food Security Act in mind, and they wanted to build up a huge stock?
The Food Security Act has come later. I think it's a mindset problem.
Okay.
It is that we are kind of stuck in this assumption that the key variable or the key to the poor's well-being is wheat and rice. This is something which was definitely true 20 years ago, 30 years ago, 40 years ago, but the whole system is changing, and that goes back to that per capita income change. The per capita income very roughly doubled, it was growing at something like 3.5, it doubled to 7%. People still don't appreciate that what means. That means that within a generation, the average income will double.
Okay.
It's a drastic change in the whole way the economy has been functioning, and our mindset is still of the old way. So this stocking problem, if you are withdrawing, you are raising the minimum support price or the procurement price. Historically these used to be completely separate. We have mixed them up together, and basically we are not managing the food economy the way it should be managed.
I mean, stocking could be responsible for the rise in cereal prices, but most of the increase has been in vegetable and fruits. Now so, there is no stocking. So what can we do to ease
so one
supply
issue
constraints?
is that we have a rise in wheat prices of something like 14 to 18%, the last data which I saw, despite the fact that we have tons of wheat stocks. The second problem, you're quite right, the source of it keeps changing, and it all linked to the supply chain. Earlier people were sometimes it's milk, but if you take fruit and vegetables, again this is an old problem. I've been analyzing this for 20 years in the finance ministry. Usually it is fruit and vegetables, in between every once in a while it's milk. So again the problem is the supply chains, right? We are not modernizing our system. The whole supply chains need to be changed. So if you look at the prices, let's say there are three elements of the supply chain. One is, as urban areas grow, the supply of vegetable gets further and further away, right?
Sure.
So you get more transport costs.
Sure.
As economy grows, real estate prices rise, so that you get a rising gap between wholesale prices and retail prices. So there are all these three things. The basic productivity of fruit and vegetable is not expanding rapidly because there is no competition, there is no pressure. So you need to reform the agricultural system. For too long, and earlier there was some justification that we said, okay, too many people are dependent on agriculture, we got to go slow on it. Well, we've been going slow on it for 20 years.
And
at some point we have to start changing.
Fruit and vegetable, I think there's a lot of wastage as well.
That's the supply chain issue, yes. So for practical people, that is part of the problem, that huge amounts of food being perishables, huge amounts of fruit and vegetables are wasted, and that means that the farmer also does not have enough incentive to invest in more productivity. So it's a vicious cycle. That's why we talk about the whole supply chain, not just about the farm.
Would you agree that since supply constraints cannot be kind of corrected overnight, in the interim the only way you can keep prices under control is by squeezing demand through higher interest rates?
No, I do not agree.
Which is what the RBI seems to be kind of
I don't agree, because I think that if you squeeze demand now, what you can try to do is squeeze the demand for these particular products by putting a tax on them, which nobody is going to do, or by not allowing the procurement price to rise so fast. But again, that is not something that is politically feasible. Just using a broad spectrum measure like monetary policy then has negative effects on output. So there you are really faced with, if you try to solve supply side problem with demand side measures, yes, they can be made to work. I am not saying they can't work, but you have this huge collateral damage. So it's a choice. Why not address the supply side problem by policy changes?
One of the puzzles really has been that there seems to be so little public anger and angst about rising prices. Unlike, if you remember the earlier price when a government lost because the onion price rise, there seems to be much less anger. Is it because there are so many other things to be angry about, or is it because incomes have risen and people now feel okay? Which of the two is it?
Very good point. Again, if you go back to, that's why I took some time to tell you that the rate of income, average income growth has gone up. That means the real incomes of even the people in the rural areas have been rising. So yes, that is correct, because they are no longer on the margins of existence. Many poor people have been raised above these critical margins. So yes, there is less of death. There is less of death from hunger, I would say, despite all the earlier discussions on hunger, and therefore, and even the middle class really. It has moved way above that margin. I mean, they were already above the margin, they are way above it. So they worry more about electricity prices or maybe scooter prices or whatever they purchase. and less about the food part of it. So, it's part of the positive lining of that rate of increase in incomes.
Okay. But there also is, as far as fuel and power is concerned, because the administered price mechanism, there is a lot of suppressed inflation. So what would you think actually the real inflation number would be, closer to 12-13%?
Well, though it's an arguable point, I used to argue when I was in government that in a way the fiscal deficit translates indirectly into inflation in any case.
Eventually, yes.
So, basically the technical point here is that a one-time rise in price is not inflation. Inflation is a process, and that's why we talk about expectations. You know, a one-time rise in prices, let's say of diesel or petrol, if it leads to inflationary expectations, becomes inflation. So if you can stop the inflationary expectations, it is not inflation.
Okay.
It's a little bit of a technical point.
Why does the government not raise prices?
But the effects of that, of the fiscal deficit, means you are injecting excess demand for non-tradables. Actually, I'm glad you brought it in, because what it is doing is that agriculture actually, because of controls, is a kind of non-tradable.
Okay.
So when you have a higher fiscal deficit, it's shifting the pattern of demand. It's demanding more of non-tradables, you see, because imports can always come in, and the current account deficit goes up. But the people who get hurt is through non-tradable prices.
But I'll have to interrupt you there, Dr. Virmani. Very interesting discussion, but we have to slip into a very short break. Please stay with us. We'll be back very, very soon. Welcome back. Well, the week also saw the drama about the US debt ceiling move center stage. This kind of political grandstanding is not new. The problem for the rest of the world, however, arises because of the unique position of the US dollar and hence of US Treasury bills. A large part of the reserves of central banks are held in supposedly risk-free US government IOUs or Treasury bills. So any default by the US because of failure to reach an understanding on raising the debt ceiling would have had catastrophic consequences for the global financial system. Fortunately, there was an 11th-minute agreement, but that's only till February 2014. We'll ask Dr. Virmani to throw more light on this, what this means. But first, our bureau report.
On this vote, the yeas are 285, the nays are 144. The motion is adopted.
The United States closely averted its first default in its history on Wednesday night after the Senate announced an 11th-hour compromise deal to reopen the government and raise the debt ceiling until early next year.
Tonight, the unnecessary shutdown America has been enduring for 16 days comes to an end.
The Senate has now voted to approve this agreement, and Democrats and Republicans in the House still have an important vote to take. But I want to thank the leaders of both parties for getting us to this point. Once this agreement arrives on my desk, I will sign it immediately. We'll begin reopening our government immediately.
Following the deal, shares in Tokyo closed higher, while in Europe they fell slightly in early trading. Big Asian exporters, including China and South Korea, also faced the risk of a slump in global demand if a US default had disrupted other economies. China's government, which is Washington's biggest foreign creditor with $1.3 trillion invested in treasuries, welcomed the end to the standoff. Experts say the controversy over the debt ceiling was on account of low efficiency of the political structure of the United States.
The U.S. Congress is more polarized than any time in my memory. It's really unfortunate. There's too many party line votes. There's too much bickering between the parties, so it's not easy to get things done. And that's a problem right now.
Ultimately, the agreement stacked up as a political achievement for Barack Obama, who refused to negotiate on changes to the healthcare law, and a defeat for Republicans, who were driven by Tea Party conservatives in their ranks and suffered a backlash in public opinion polls. But the congressional vote is only a temporary ceasefire between Republicans and the White House. Bureau Report, Rajya Sabha TV.
Arvind, for whatever it's worth, it's good to know that we're not the only dysfunctional democracy. I was reading somewhere that actually Washington, by some political correspondent, that Washington is the biggest threat to the US economy, just like we'd like to see New Delhi as the biggest threat to the Indian economy. Would you agree? And what really is wrong? After all, we've only bought time till February 2014. So what does it mean for us?
Right. The political economy is very interesting, but you know, there's a small economic point here. Basically, even in a domestic market, the government rate, interest rate, the risk, what is called the risk-free rate, is the benchmark for all other rates in the economy. The problem for the world is that the US government risk-free rate, the benchmark, is for the whole world, right? It's a global financial markets in which the US plays a very large role. So the threat arises from that if that risk-free rate is disrupted, the whole global financial system is affected and it becomes uncertain. So what happens if that happens is means that all the financial markets where we are borrowing, where our capital flows come from, and of many other countries, many companies, large companies, everybody is affected, and this uncertainty creates the problem. In our case, it would be the uncertainty about capital flows, right? So anything we do, whether it's to change the interest rate by the RBI or whatever, everything would become more uncertain. So that is one aspect of it. The second aspect is that uncertainty, which affects all people who deal in global financial markets, eventually carries over into the real economy. So people get cautious about buying things. If they have a limited amount of money, they think, oh, we may not be able to borrow anymore because the financial system is disrupted. So they cut down their orders, and therefore our exports could be affected. So basically these are these two channels. One is the financial channel, and the second is the real channel in terms of exports, which affects us.
So what can we do to kind of not allow the US to hold the whole world to ransom like this? Is there any way out at all?
The problem is that you can't solve political problems. Like to get back to your first question, there is a big dysfunction, and in my personal view, it's really a battle between the extremists in the Republican Party and the president. There's a widespread view in Washington, which I share in the US, that the so-called Tea Party just cannot accept the fact that Mr. Obama has won a second term, and basically it's a political battle, and somehow these people just don't care what the effects are on the US economy or the world.
But isn't it also partly linked to what the US's exorbitant privilege, as they call it, the ability to issue, you print your own currency, and that's the international reserve currency, and that's what gives the US's unique position of calling all the shots?
Yes and no, because normally a disruption like this would lead to a depreciation of the US dollar, okay? That really wouldn't have huge effects on everybody else of this kind. The centrality arises because it is the biggest capital market in the world, okay? Now, why is it that so? You have to ask all those who invest there. Well, it's freer, it's more open, and is perceived to be safer. But who do I mean? Of course, China everybody talks about, but the Saudis and everybody else who has, the Germans, whoever, everybody who has funds, extra funds, finds this as the safest market. Now, if there were alternative safe markets which were equally open, where you could go in and invest in everything, this would change, and it will change.
Okay. So as of now, the US dollar has that unique position because it kind of deserves it. It has the widest, most liquid
but it's not just the dollar, it's the asset markets. It's the assets, Anybody can go in and buy real estate in New York or any other part of the US. You cannot do that in too many countries.
So on that note, we'll slip into another break, but please be with us. We'll be back very, very soon for our last story. Welcome back. The 2013 prize in economic sciences in memory of Alfred Nobel has been awarded to 3 American economists, Eugene Farmer, Lars Peter Hansen, and Robert Shiller. All 3 were awarded the prize for their work on the empirical analysis of asset prices. While Mr. Farmer has been hailed as the father of efficient market hypothesis, Shiller is famous for knocking holes in the very same theory and arguing that, on the contrary, in the short term, markets are far from efficient. Hansen, a macroeconomist at the University of Chicago, has shared the prize for his development of statistical methods to test theories of asset pricing on empirical data. We'll ask Dr. Virmani to explain their work to our viewers. But first, this Bureau report.
Markets drive the present-day global economy in a big way, a fact that this year's Nobel Prize in the field acknowledges. The Royal Swedish Academy awarded it to the 3 American economists, Eugene Farmer, Lars Peter Hansen, and Robert Shiller. It said the 3 economists enriched our understanding of the way financial markets work when they do. Also known among economists as the father of modern finance, Farmer is based in University of Chicago.
His prize-winning work shows predicting stock prices in the short run is extremely difficult. That's because market prices react surprisingly fast to new information. Schiller, a Yale University professor, on the other hand, showed this is not necessarily true over longer periods. His research also found that asset prices could be overvalued, which led him to warn of irrational exuberance in house prices before the 2008 collapse. Also from the University of Chicago, Hanson's work balances the two approaches. His techniques for analyzing data and asset prices allows economists to test the theories on what drives markets. The Economics Award was set up in 1968 by Sweden's central bank. The prize money of nearly $1.2 million, a gold medal and a diploma will be presented to the laureates in Stockholm on 10th December, the anniversary of Alfred Nobel's death. Bureau Report, Rajya Sabha Television.
Arvind, what exactly does this mean? What have they been given this wonderful prize for?
Well, to me, the politics is very interesting because they obviously tried to balance. You know, we've had this huge global financial crisis in 2008.
Because nobody knows how to price assets.
Well, no, it's more than that. It's because Pharma's way of looking at it and his people who developed it were predominant in the global financial sector, which we were just talking about in
the pre-crisis.
In New York, in the financial sector, and in Chicago and in academia all over, which led to this extreme view that markets are perfect. Anyway, as has been briefly explained, you know, what he showed was they're efficient. That basically means that when new information comes in, it's quickly priced into everybody and there's a kind of information flow.
Okay.
And the extreme version of that is perfect information, which is what led to the crisis. So one of the conclusions which is more interesting, which these extreme views led to, was that you don't need to regulate the market. That the market is so perfect that it will adjust in a short time. That is where the other Schiller comes in, and he was among you know, the early ones in a sense to say no, that's not always true, because we have examples of asset bubbles from history. Now they may not occur all the time, but we have regulations precisely because things are not clear. If everything was black and white, you don't really need regulation.
So all
regulation is actually to gray areas. And you have to guard against these gray areas because one day it could become black. So what is the point here? The point was that when expectations get onto a wrong track, then nobody can make money by deviating from it. So in some ways, one way to think of it, it's a multiple equilibrium situation or a second equilibrium. If everything is going fine, there is a stable equilibrium which looks efficient, as Pharma says. But if you get onto this unstable equilibrium, then nobody can dare, because even if you have information, even if you think that, you know, this is a bubble, one person gets off it, everybody keeps going, you lose money. Okay? So it doesn't work.
So all of which means that even if we don't have the perfect model to price assets, what it really means is that regulation becomes very, very important.
That's right. That is the key implication which the world realized. I mean, those of us who were never taken in so much by the first model and also appreciated the second model always said that there are needs for regulation, and these are sometimes more in developing countries than in developed countries, because still in developed countries the markets are a little more perfect than they are in India, say. I mean, I can tell you, and we always thought that we have a lot of inefficiencies which require us to regulate. That means doesn't mean that regulation should become an end in itself, or that it should lead to excessive control, but you have to be careful.
Absolutely. Thank you so much, Dr. Virmani. It's been a great pleasure having you. But on that note, we come to the end of this program. But before we close, a quick look at the key takeaways. As far as inflation is concerned, there really is no alternative but to tackle the supply side problems. Unless we do that, I think inflation is here for a much longer time, and that's what Dr. Virmani's take is also. As far as the US debt ceiling is concerned, this is something that we will have to live with, because the US dollar's unique position arises because US asset markets are so unique in themselves. As far as the Nobel Prize winners are concerned, well, we really don't have the answer to price assets, but we really do know that regulation has become very, very important, and we cannot ignore that. And on that note, we come to end this program. Thank you so much for being with us, but we'll be back next week, same time, so please stay with us. Thank you.